All right, so today we're going to unpack this whole unit economics thing. Um, it's one of those terms that gets thrown around a lot with startups, and it can sound kind of intimidating, but it's actually super important. So we're diving deep today into this article we found called Unit Economics for Early Stage Startups, From Idea to Seed. It was published on the Kayna blog pretty recently on October 26th, and I think it's got some really good stuff in there. So, imagine you're at a startup pitch event. It's all exciting. Everyone's buzzing with energy and ideas. And suddenly an investor leans in and asks, what are your unit economics?
Mm,
How would you answer that?
that is the question,
Yeah.
right? That's the question that can make or break a pitch. Because unit economics, it really gets to the core of whether your business model, is it actually viable over the long term? Can you
Yeah.
actually make money as you grow?
Yeah. And the article really highlights how the whole investment landscape has shifted. It used to be all about just growing as fast as possible. But now investors are like, okay, show me the money. They want to see that clear path to profitability.
Exactly. They want to see that path.
Yeah.
They don't just want to hear about user growth anymore. And the article even mentions this accelerator demo day where a bunch of founders just totally fumbled when they were asked about their unit economics.
Ouch.
Yeah, it's a tough question if you're not prepared. But it really underscores how crucial this whole concept is. So where do we even begin? Well, one of the most important metrics you got to understand is the LTV to CAC ratio.
Okay, yeah, I've seen that ratio mentioned everywhere, LTV SAC. But to be honest, I'm not always sure everyone really understands what it means. Can we break that down for our listeners? Like, what does that ratio actually tell us about a business?
Absolutely. So it basically boils down to this. Are you making more money from your customers than it costs you to get them in the door? That's the fundamental question the LTV to CAC ratio helps you answer.
Got it. So LTV stands for lifetime value, right? But what does that actually mean in practice?
Yeah. So lifetime value is all about the total revenue you could realistically expect to make from a single customer over their entire relationship with your business.
So not just the first purchase or the first month's subscription, it's about their entire journey with your company.
Exactly. And then on the other side, we have CAC, which stands for customer acquisition cost.
Mhm.
And that includes everything you spend to acquire a new customer, your marketing, your sales, your onboarding, the whole shebang.
So it's about understanding the entire profit you generate from each customer throughout their lifetime with the company, not just landing the initial sale. But how do you actually calculate these figures? Like, is there a formula or something?
There is definitely a formula. And it's not as complicated as you might think. So let's start with LTV. To calculate that, you need a few key pieces of information. First, you need your monthly recurring revenue, or MRR. Then you need your churn rate, which is the percentage of customers who leave each month. And finally, you need your gross profit margin, which is your profit after you deduct production costs. The article walks through a really clear example. Let's say you have a monthly subscription service that costs $30. So that's your MRR. And let's say your churn rate is 5%. That means the average customer sticks around for about 20 months. And finally, let's say your gross profit margin is 60%.
Okay, I'm following so far, but how do we take those numbers and actually turn them into the LTV?
Well, you just multiply them. In this
Mm.
example, it would be $30 times 20 months times 60%. And that gives you an LTV of $360.
Okay, $360, got it. Now, what about CAC? How do we figure that out?
Remember, CAC includes all your costs for acquiring a customer. So let's say your company spends $228 on marketing and sales in a month. And through those efforts, you acquire 1.25 new customers.
So you divide the total spend by the number of customers you acquired.
Precisely. In this case, the SECI would be $182.40.
All right, so we have our LTV, which is $360, and our PAC, which is $182.40. Now, how do we get to that LTV CAC ratio?
You simply divide the LTV by the CAC.
So in this example, it's $360 divided by $182.40.
That's right, which gives a ratio of 1.97.
All right, we got our ratio 1.97, but what does that actually tell us? Like, what's considered a good ratio versus a bad ratio? I know the article mentions a benchmark of 3-to-1 for SaaS businesses, but is that a universal truth, or does it vary depending on the industry?
That's a great question. It definitely depends on a lot of factors. A 3-to-1 ratio is often cited as a good target for SaaS businesses, but it's not a hard and fast rule. Benchmarks can vary widely across industries.
So context is key. It's all about comparing yourself to similar businesses in your sector.
Exactly. You need to know your industry and your market. And even within the same industry, a good ratio can look different, depending on the business model, the growth stage,
Yeah.
the risk tolerance. Like a company that's really focused on rapid growth they might be okay with a lower ratio initially,
Yeah.
knowing that they can optimize later on.
So it's not necessarily a red flag if a startup's LTV to CAC isn't amazing right out of the gate, but demonstrating that you have a plan to improve it over time. That's what investors are really looking for.
Absolutely. They want to see that you understand the levers and how you can tweak things to achieve that sustainable profitability. But, LTV to CAC, while it's a super valuable metric, it does rely on estimates and averages. The article introduces another measure that I think is really interesting. It's called customer profitability analysis. And it's a more granular way of looking at whether you're truly making money. From each customer over a year.
Oh, that sounds like a good reality check. It's one thing to have a good LTV to CAC ratio, but are you actually turning a profit on each customer in the long run? That seems especially important for early stage startups who might be burning a lot of cash to acquire those first customers.
Exactly. You're hitting on a key point. Early stage companies often prioritize growth over immediate profitability. But understanding customer profitability from the get-go can help you avoid some serious pitfalls down the line.
So how do you actually perform this customer profitability analysis? What does that process look like?
Well, it really comes down to getting into the nitty-gritty of your financials. You start by tracking all the revenue a specific customer generates over a year, and then you deduct all the costs associated with that customer, both direct and indirect costs.
Great. So what are some examples of those direct and indirect costs?
Sure. So direct costs would include things like the cost of goods sold or the cost of providing customer support. Indirect costs might be things like marketing and sales expenses that are allocated to that customer.
So it's about painting a really complete financial picture of your relationship with each customer. I imagine this can be pretty eye-opening for some businesses. You might think you're doing well based on your overall revenue, but then this analysis reveals that some customers are actually costing you money.
It definitely can be eye-opening, and that's why it's so valuable. It allows you to identify your most profitable customers. And just as importantly, understand the factors that are driving their profitability. You might discover that certain acquisition channels are bringing in those high-value customers, while others are attracting customers who churn quickly or require a lot of support.
That's powerful insight. You can double down on what's working and cut your losses on what's not. But the article mentioned that this type of analysis can be a bit unflattering, particularly for early-stage startups. Why is that?
Well, in the early stages, startups are often still figuring things out. Their operations might not be as efficient. Their customer acquisition costs can be high. As they're testing different strategies.
So their customer profitability might not be pretty initially, but that doesn't mean they should ignore it, right?
Exactly. It's a learning tool, not a judgment.
Yeah.
By tracking customer profitability over time, startups can identify areas for improvement and start optimizing.
It's all about using these metrics to inform those critical early decisions and set yourself up for success in the long run.
Precisely. And, the article also touched on some initiatives to lower CAC and increase LTV, but it didn't really go into detail. So maybe we can unpack those a little bit.
Yeah, absolutely. Let's dive into some actionable strategies. How can startups actually move the needle on these metrics? So many levers to pull, so little time. But where should startups really focus their energy? The article mentioned pricing as a key factor, but it didn't really go into detail.
Pricing is a fantastic place to start. It's one of the most direct levers you have to impact both CAC and LTV. Are you charging enough for your product or service? Many startups, especially in those early days, they underprice themselves out of fear of scaring away customers.
Yeah, I can see that you want to gain traction, you want to be competitive. But is there a risk of leaving money on the table? If you're not pricing strategically, how do you find that sweet spot?
It's definitely the balancing act.
Yeah.
But there are ways to find that sweet spot. Thorough market research is essential. You need to understand the true value you're providing and what customers are actually willing to pay. Experiment with different pricing tiers. See what resonates with your target audience. A/B testing can be super helpful here.
Yeah, I can see how that data-driven approach would take some of the guesswork out of it, but it's not a set it and forget it kind of thing, right?
Definitely not. Pricing should evolve as your product develops, as your market changes, and as your business grows. You need to regularly review and adjust your pricing based on all those factors.
Got it. So we've talked about pricing. Now let's shift gears to customer acquisition costs. Any tips for startups who are trying to lower their CAC?
This is where it gets fun. There's so much room for creativity when it comes to customer acquisition. One approach is to really focus on those organic growth channels, like content marketing and social media. These can be much more cost-effective than traditional paid advertising, especially for startups who are working with limited budgets.
Yeah, content marketing, that's all about creating valuable content that attracts your target audience without having to spend a ton of money on ads.
Exactly. But it's not just about creating content, it's about getting it in front of the right people. Think about your distribution strategy, your blog, social media, guest posts on other websites. It's about becoming a thought leader in your space and building trust over time.
So it's a longer game, but potentially a much more sustainable one.
For sure. And don't underestimate the power of word of mouth marketing. Happy customers are your best salespeople. Encourage them to spread the love by offering incentives for referrals.
Oh, yeah, that's so true. People trust recommendations from their friends way more than any ad.
Absolutely.
Yeah.
And it's a much more cost-effective way to acquire new customers. Partnerships are another great strategy. Look for businesses that target a similar audience as you, but offer complementary products or services. Team up to cross-promote each other's offerings. It's a win-win for everyone involved.
I love that it's all about collaboration. Okay, so we've covered lowering CAC. Now let's talk about increasing customer lifetime value. How can startups keep those customers coming back for more?
It really boils down to nurturing those relationships and going above and beyond to provide an exceptional experience. Customer service is paramount. Every interaction should leave your customers feeling valued and appreciated.
Because happy customers are loyal customers, and loyal customers are more likely to stick around and spend more.
Exactly. Another powerful tool is a well-designed customer loyalty program. Think rewards, incentives for repeat business, exclusive perks, anything that makes your customers feel like VIPs.
Yeah, loyalty programs are everywhere these days, and for good reason, they really work.
They do. And don't forget about staying top of mind. Keep your customers informed about new products, services, and promotions through targeted email marketing. But don't just bombard them with sales pitches. Provide valuable content that keeps them engaged and strengthens that relationship.
You know what's striking me is how much of this comes down to relationships, improving unit economics and customer profitability. It's not just about crunching numbers. It's about creating those positive, lasting connections with your customers.
You absolutely nailed it. That's what truly separates the good startups from the great ones. The ability to not only acquire customers, but to cultivate those relationships and turn them into raving fans.
Such a great point. So for our listeners who are maybe feeling a little overwhelmed by all this information, what's the one key takeaway you want them to remember?
Obsess over understanding your customers. Know their needs, their pain points, their aspirations, what makes them tick. By putting your customers at the heart of everything you do, you'll naturally see improvements in your unit economics. And you'll build a business that's not only profitable, but one that truly thrives.
That's fantastic advice. Well, we've covered a ton of ground today, but this is really just the tip of the iceberg when it comes to unit economics. I encourage all our listeners to keep exploring and learning. It's an ongoing journey, but it's one that will definitely pay off in the long run. Thanks for tuning in to this deep dive, and we'll see you next time.